Portfolio Builder update December 21st. If you're getting this video late, make sure to subscribe below. Click the yellow bell icon to get an instant notification from YouTube every time we issue a new trade alert update. This morning, the SPY jumped up on news from the Fed that they're looking for reasons to slow down the rate hikes. Market jumped on that and then crashed $6 on the SPY so far today. And this is known to be a very volatile day because of so many different options and futures contracts all expiring at once. If we zoom out to the weekly chart, we can see this has gone to an extreme, especially with such a positive outlook on the economy going into 2019. My expectation is for some green candles to come, as I believe this is very oversold at current levels. Yesterday we exited our gold position, which was good timing as gold has sold off today. And we also exited our TLT position, which I believe is also overbought. And despite the stock market continuing to go down today, it is not creating a safe haven rush to the TLT. And meanwhile, the VIX remains highly elevated at the 2790 current price. I don't think this will last for very much longer. And if we do look at the weekly chart on the VIX, you can see this is a historically high level of volatility. We took advantage of this earlier this week by buying shares of the SPY ETF and then selling a in-the-money covered call. This allows us to maintain our SPY position through the volatility and then let the equity appreciate if and when we get a sharp reversal going into the close of the year, which is what I highly suspect will happen. And if we look at the weekly on the TLT, I do want to get back into a large bond position in our portfolio, but given the rare circumstances with the volatility in equities, at this point we are in a 70% equity position and 30% cash position, after previously being 40% bonds, 40% equities, 10% gold, and 10% cash. And today we'll look at some interesting articles discussing what sort of bear market we may already be in. Are we getting near the end of it? And why we may not have this 2008 style, 2000 style crash in the immediate future, and rather quite potentially disappointments in growth in 2019, causing central banks to start printing money and continue the bubble. Our equities portfolio is globally diversified with allocation sizes representing each country's GDP, China being the second largest position after SPY through the MCHI ETF. And once we hop over to the news, we'll see that China has announced that they'll be lowering tax rates and trying to stimulate their economy with easing monetary policies going into 2019. So this very well may signal the end of their bear market, because when we do look at the grand scheme of things, their GDP is growing at a phenomenal rate, and this stock market is now down as much as 34% over the past 12 months. So could it go farther? Yes, but in the long run, do I think it will go up? Yes. Gold is a position we recently closed just yesterday. However, it is a long-term position that I do want to maintain in our portfolio. We'll likely re-enter into gold after we catch a good rise in our global equity portfolio. Short term, it has central banks raising interest rates and decreasing the monetary supply, which should be negative towards gold. But in the long term, the government's continued to rack up the deficits, and thus it forces the central banks to continue printing money and creating inflationary problems. Japan's sell-off is accelerating today, currently down 23% from the high back in January. representing a much smaller position in our portfolio is Brazil, Germany, India, and the UK. All of which are down substantially in 2018. And of course, this has been noted today as the worst year in history, with the only asset going up being inverse funds against the underlying assets, and of course, cash. In a little bit, we'll look at our model portfolio and our exact holdings and option contracts we currently have live. But first, let's take a look at all of the top news from Twitter, Reddit, Seeking Alpha, and different news websites today. Cryptocurrencies have shown a lot of healthy signs this week, breaking over 4,100 this morning. It's back below 4,000 right now. John McAfee is well-known figurehead in this space. Says the following: Bitcoin 4,100. Altcoins are cranking. The general mood is elevated. Business deals are flourishing as the bull in town looks, smells, and feels like it. Are you ready for it, people? And of course, we do have digital assets in our portfolio, utilizing the same strategy we're putting in play in equities. And this portfolio, portion of our portfolio was launched several months ago. It was down 36%. Now it's only down 25%. We'll take a look at that in a minute. And here's the charts this morning. Bitcoin is at 4,076. The big mover is Bitcoin Cash, also called Bitcoin ABC, which was as low as $90 not too long ago, just a few weeks. Of course, a few months ago, it was trading at $600, so it's been a wild ride for investors holding cryptocurrencies. Also, Facebook announces it's developing technology to interact with stable coins. So that's not necessarily beneficial to any of our top holdings currently, but good for the overall space. And despite the price of Bitcoin dropping so significantly in 2018, trading volume is at a record high, greater than the mania from 2017, apparently. Now, of course, we've got a lot of traders involved who are trying to make big swings in the markets and use leverage to create profits. So that can be a good cause of this supposed liquidity in the market. It's definitely a lot more shallow than most people think, which means a lot of real selling or a lot of real buying really swings the price quickly, whereas a lot of this volume we are seeing right now is simply people trying to manipulate it by going in and out. And this chart right here really sums up why you want to hold gold and digital money assets for the long term. Central banks, or rather the governments and the people voting for these governments, are addicted to debt. And so they pass on the bills to later generations by simply bailing themselves out with free money. And this trend will quite likely not stop, and thus the value of gold and digital assets will continue to grow over time. Now, right now, we're specifically in a monetary tightening environment, but those moments don't last very long because it typically cripples markets and forces them to once again ease the monetary policies. And not to mention, here at the United States, we're looking at $1 trillion deficit next year, which means this is not going to end anytime soon. Right now, I'm using around a third of my cash position to buy digital money, and I may increase that in the near future during the next dip. Now, don't go all in on cryptocurrencies, even though there are some signs of hope. It certainly could go much lower very easily. There's a lot of people who are losing money as long as Bitcoin's under 6,000, namely miners. The miner industry really took a big hit, and this could force liquidations in big companies such as Bitmain And someone going out like that could be another catastrophic event to drop Bitcoin down to the $2,000 to $3,000 range. So while I'd like to hold cryptocurrencies, I wouldn't be over leveraged in that market right now. And for that matter, ever. At any point in time, I would never have more than my cash position at risk in my total portfolio. So hopeful for the bull market ahead in cryptocurrencies, but play it safe. Don't be an idiot and go all in. And then here's that yellow vest guy wearing the buy Bitcoin. Here's what happens when governments try to raise taxes and decrease deficits. The people revolt. And so here we have the Bitcoin Titan fighting the big bad dollar wolf. Top U.S. equity news / gossip. Extreme fear. Has this ever gone to 1 or 0? Currently reading a 5. Extreme fear. Typically that's a good indicator to buy. And this cartoon is hilarious, but really sums up the problem with the stock market right now. It's a bird, it's a plane, it's a tariff, man. And there's Donald Trump smashing into the ground. So we'll see. Can they strike a deal and reverse the sentiment of the markets? I believe they both want to, as both countries are undergoing a lot of political pressure and pain right now. If they don't, will the equities market go lower? And quite likely the answer to that is yes. If this continues to escalate and we get slower growth around the globe, most certainly this could be drawn out and go significantly lower. Meanwhile, Trump warns of a very long shutdown if Democrats vote no on Wall, which I believe they did not. So we'll see how this can potentially escalate. And apparently if you had predicted this yesterday, you could have made a 580% return in one day. Here's a chart that's been passed around quite a bit for quite a while. Just shows every time the interest rates raise, it's typically correlated right next to a stock market crash shortly after. And so the big question now is, are we at the end of the bear market, or are we just getting into the middle of it? While world equities have been down for a year, the U.S. stock market's really just started its descent 3 months ago. So will this course of action be quickly reversed with the Fed becoming more dovish next year, or will they stick to these interest rate hikes and continue to pressure the equities markets? This is a 100-year chart of the SPX, which is kind of just put together with random different sources of data. Not random, but just different sets of data, because the SPY ETF and the SPX weren't around that long. Was just trying to give you a general idea of how rare bear markets are, and even though there's been plenty of them, they've always rebounded and moved to new highs as the years go on. Here's the graph showing the percentage of assets with a negative total return, 93%, the worst in the last 120 years, which means this trend will quite likely reverse in the near future. And what's fascinating is that last year was the best year for markets with this same measurement, when just 1% of assets finished with a negative total return. Which leads us to a point in time where stocks and treasuries are testing important support and resistance lines for their yields and, of course, the stock price. The put to call ratio is now skewed highly to the put option market. So at some point these put options will need to cover. And of course, anytime Gartman comes out with a prediction, if you do the opposite, that usually works out well. This is more just for a laugh. Gartman's stock prices continue to plunge, and there's nothing else that one can say other than that. The internals remain manifestly, harshly overwhelmingly, one-sidedly, shockingly, dismayingly, margin-creatingly bearish. Here's a tweet about the TLT. The Santa rally is here. It's just not the asset class you expected. Of course, historically, December is very bullish for stocks and other assets like that. But this year, we got the opposite. We have the TLT and GLD going up. And again, we did take profits yesterday on that, as I think they have hit a short-term high. And this is a cool chart. If you want to pause it, you can look at it. It shows you the top performers from top to bottom of the different years. You got bonds, non-US stocks, gold, bonds, real estate, US stocks, real estate, US housing, US stocks, non-US stocks. Cartoon of the day, 007, bond, long bond. So we'll definitely be getting back into our bond position to make it through a crazy year ahead, certainly. Another chart about debt. 3 charts that show why the U.S. should stop ignoring its debt problem. Currently just under 80% federal debt held by the public percentage of GDP. Now look at some of the international country index ETFs we're holding. We can see that the sell-off has been international and not just in the U.S. Short sellers are targeting Chinese stocks where there's nothing worth saving, quote unquote. China's announced that they're going to ease monetary conditions and lower taxes. Global Times, China will implement a proactive fiscal policy and prudent monetary policy next year. The proactive fiscal policy will aim to improve efficiency and large-scale tax and fee cuts, which will be implemented. Meanwhile, the big picture for China is that they are one of the fastest growing economies of the world and on track to become the #1 superpower of the world. And they're slowing down, sure, but will that last forever? Most likely not. And you can see China has been very busy over the past decade. In terms of the real GDP, it's already arguably doing a bigger number of gross dollars per year. The German economy is one of the bigger of the world and part of our portfolio. Currently one of the biggest sell-offs in the different positions we're holding on to. But when you look at the bigger picture, looks like good times are shortly ahead for EWG. And there are a number of ETFs closing at 52-week lows today, including Germany, France, Sweden, Belgium, Ireland, and Japan. Now, we'll take a look at our portfolio and a few other articles I've collected, but there's no trade alert today or next week. The next trade alert will be December 31st, 2018, where we'll continue to sell covered calls against our equities positions while volatility is high to help generate returns even when the market goes sideways or down. Moving along, I have 3 articles from Zero Hedge from 3 different authors and a couple Seeking Alpha articles with market predictions in 2019. And then we'll close out by reviewing our platform, the positions we're currently holding, and plans for next week. Hammered traders brace for quad witching volatility explosion. Just when the market participants were hoping for an easy run into the holiday week after being pummeled by Powell, trounced by Trump, and damaged by Doodley, traders are bracing themselves for a surge in volume and volatility today as the ominous sounding quad witch awaits, a day in which all 4 of the different types of options and futures contracts expire on the same day. The turbulence, which tends to cluster around the market open and close, is adding another layer of uncertainty in a market where traders are already on edge. Quad witching weeks tend to be extremely volatile as large derivative positions are rolled over. Just what the markets need right now, right? Here's an article from Zero Hedge, where Bridgewater CIO sees near recession level growth in 2019. Jensen says he expects economic growth to be significantly weaker in 2019, which will reach near recession levels, and if correct, would put the U.S. economy on the road to recession as soon as next year, sooner than the consensus forecast for a recession in 2020. And they manage $160 billion in assets. Of course, perhaps they're waiting for retail to jump on the bandwagon so they can reverse the trade before they announce it. Douglas Cass had a piece out today, Nowhere to Run, Nowhere to Hide. He surprisingly called the crypto crash this year, as well as a stock market pullback. Current prediction is a rebound to the 2600 level, or that would be 260 on the SPY. Currently trading at 242 going into the long weekend and a short trading day Monday before the Christmas break in the markets. As far as his precise predictions from here, he says that over the last year, I have consistently written that fair market value for the S&P index was between 2,400 and 2,500, well below the expectations of every major Wall Street strategist. And so he's expecting a run-up to close the year out, a crash to lows in 2019, and then the announcement of QE4 to start the whole cycle all over again. Here's an article out from Moat Capital Management from Seeking Alpha, a long-only growth registered investment advisor. So, of course, that does come with quite a bit of bias to the long side. There are signs we are nearing a market bottom. Technical indicators suggest a reversal. Volume and volatility support that outlook. His first point is that volume has been slowing down during this period of drawdown in December, indicating that the sell-off could be nearing a conclusion. And he also sees the spike and slowdown in volume on the QQQ. Then he likes to compare this to the 2008 crash, where we have a spike in volume and then decreasing volume as market then begins to rebound. Points out that the volatility has failed to break through the 2650. The VIX futures currently project a slowdown in volatility, although still definitely higher than we're used to in 2017. Then he points out that the FANG stocks, the leaders of the market, could be potentially bottoming out at their recent top or low and then getting ready to bounce higher. And so finally, that leaves us with our portfolio to review. We are currently down 0.79%, which is a lot less than the equities market has gone down since we launched this December 10th. This is a new technology and platform that's designed to generate retirement income. Currently, we are operating with a 70% stock allocation, 30% cash, 0% gold and bonds. We were 40% bonds as of yesterday and 10% gold, but with this dramatic sell-off in equities, we pivoted to a short-term position that is 70% stocks, 30% cash, with about a third of my cash currently holding cryptocurrencies, which we'll take a look at in a minute. I try to purchase lots of 100 of each ETF, and this is allocated based on the previous year's GDP. So based on that country's GDP, we are forecasting the profits of the corporations for the future year, and thus what percentage of our portfolio should hold each ETF. In this section of the platform, we from time to time will sell covered calls or write a put option contract to generate additional income on either our working capital that's not currently holding one of our ETF positions, or to sell a covered call against the shares we own. This allows us to generate a consistent return when volatility is at high levels And then when volatility drops, we typically just hold the underlying asset and let it appreciate on its own. So as you can see, we've been consistently writing covered calls or selling put option contracts if we were assigned to get back into the position to generate a consistent stream of income from our underlying assets despite the market dropping. So thanks again for your time on this video. If you haven't yet, click on the left-hand corner of the screen. Sign up for your free 30-day trial to the weekly income investment platform, Portfolio Builder. Have a great weekend. We'll have short written update Monday if anything dramatically changes in our portfolio. Otherwise, expect a new video on Thursday.